Nvidia, ticker symbol NVDA, reported earnings after the bell, and the stock is up 2% as of recording, but got to highs of about 5%. The market clearly likes the earnings, and we're going to talk about it. We're going to talk about Nvidia's earnings, the good, the bad, the ugly, what to expect, and we're going to answer the question, is Nvidia a buy right now? Let's dive in. But before we do, if you could please go ahead, like and subscribe. It really helps me out, guys. And it's very easy to see why the market was bullish on Nvidia here in the after hours, because it beat on the top line, beat on the bottom line, growing revenue 78% on a year-over-year basis. The analysts were expecting about 42.2 billion. Nvidia reported 44 billion. So congratulations to Jensen and all shareholders. Nvidia reported 76 cents in earnings per share versus 74 cents was the expectation, but only growing 26%. And we're going to talk about why. Why did revenue grow 78%, earnings 26%, and why did the market still bid the earnings up in the after hours? So now we have to ask the question, guys. Yes, 26% earnings growth, stellar figures, but if the company didn't grow it at par with revenue, that means that there was some operating deleveraging happening, and that is exactly true. You could see here the gross margins actually fell significantly, and as a result, net income margins fell. However, when we look at the nominal dollars of net income, we still saw an increase from 14.8 to $18.7 billion. So still very robust growth in aggregate. The reason why we actually saw margins compress here in this first quarter had to actually do with an asset write-down that Nvidia had to take because of the Trump administration and the export controls to China. That asset write-down resulted in gross margins and net margins decreasing. However, that is an intangible expense. At least that's what we call them on the accounting statement. And you can see here that when that is added back into free cash flow, and so as a result, free cash flow was still nearly 60% margin. In fact, free cash flow margins actually expanded on a quarter-over-quarter basis. The market was looking through the window of this right here, looking at the free cash flow margin and saying, hey, this business is right on track, because free cash flow printed at $26.1 billion, 60% free cash flow margins. That is why the business has $53 billion in cash, $9.9 billion in debt, a very healthy balance sheet, very strong cash flow. Nvidia is business as usual. And when we break down the revenue into its segments, you could see right here, data center makes up the majority of revenue, close to 95% of total revenues. And that is split up between compute, which is the GPUs, and networking, which is stuff like the routers, Ethernet switches, the actual cabling between services. They do about $5 billion here in networking, about $34 billion in compute. Gaming is their next biggest segment, and it's about 10% of data center, as you can see, at 3.7 billion. And then the other three segments, visualization, automotive, OEM, and other, are virtually inconsequential. These can be bigger segments, particularly automotive. Jensen always talks about how, autonomous vehicles will require a lot of compute, and that is a small segment that, can be potentially even bigger than data center in the very long term. However, data center makes up the majority of revenue, and it has seen sequential increases in revenue that has been quite outstanding. If you want to know why Nvidia's stock has been rallying the way it has in the last 5 years, it's because of this exponential curve we see here in revenue growth, seeing $39.1 billion in total revenue growth. And if this trend continues, Nvidia's stock should continue to do well. So this is actually what the data center is made up of. So you have the software layer up here, CUDA and the CUDA-X libraries. Then you actually have the hardware component, right? So this is actually the switches, the routers, the networking gear, and then this is the compute right here. These are the chips that Nvidia makes, the GPU and the CPU, mostly the Blackwell GPU and the Grace CPU, and then they fit into these server racks right here. This is the stuff that Arista Networks and SMCI make. And then you put it all together, group hundreds of thousands of them together, and that's where you get your AI cluster or your AI accelerated data center. But let's dive into the financials more granularly. You can see revenue was up 78%. However, it's very interesting to note that because of the write-down Nvidia took this quarter, cost of revenue increased substantially. Normally, cost of revenue accounts for about 15 to 20% of total revenue. This quarter, it was close to 45%. He had 17 billion. So a huge increase in cost of revenue relatively speaking. However, the company did a really good job at controlling its operating expenses. That only saw an increase of 43%. And if you actually exclude the cost of revenue, definitely would have seen some massive operating leverage in the business. However, because of that write-down, net income increased 26%, and by extension, earnings per share only increased at roughly the same clip. However, if you remove the cost of revenue right here, I'm sure this net income figure would have been close to 80, 90, maybe even 100% growth from this $14 billion figure. Very unfortunate, but Nvidia pumping on all cylinders, if you ask me. If we look at the balance sheet, it's very interesting. We spoke about the cash and debt. We could see here accounts receivable still at $22 billion. So you can 100% say that in the next quarter, you will probably going to see another robust quarter of growth. However, what you guys need to understand is that this was actually a decrease from the January quarter at 23 billion. So Nvidia will still grow, but expect growth to slow substantially in the next couple of years. Nonetheless, $22 billion in accounts receivable probably means there's $22 billion of revenue ready to go at the market. Now, looking at guidance, right? Nvidia guided roughly in line. You could say a slight beat relative to the consensus. Revenue expected to come in at 45 billion. Remember, revenue came in at about 44 billion this quarter. So you are looking at again, another sequential increase, but a substantial year-over-year increase. And this outlook actually reflects a loss in the H20 revenue of approximately 8 billion due to recent export control limitations. GAAP and non-GAAP gross margins are expected to be 71.8 and 72% respectively, plus or minus 50 basis points. We're continuing to work toward achieving gross margins in the mid-70s range late this year. So they reiterated their full year guidance for mid-70s. And generally speaking, this is actually what we see. We see when we do get the ramp up of a new model like Blackwell, margins compress just a little as it scales. GAAP and non-GAAP operating expenses are expected to be approximately 5.7 billion and 4 billion respectively. And we expect full year operating expenses growth to be in the mid 30% range. GAAP and non-GAAP other income and expenses are expected to be an income of approximately 450 million, excluding gains and losses from non-marketable and publicly held equity securities. GAAP and non-GAAP tax rates are 16.5 plus or minus 1%. So roughly guidance came in line with the analyst expectations, and you're still seeing a company that's going to be super profitable, going to grow expenses less than revenue and still growing revenue at, a double-digit clip. You're looking at like 50% year-over-year revenue growth for the quarter, and even a slight sequential increase on a quarter-over-quarter basis. On the earnings call, Jensen Huang came out and said that he's estimating we see $1 trillion in annual capex spend by 2030. Again, if that is going to go to data center, Nvidia is going to grab the largest piece of the pie. Just for context, right now, hyperscalers are spending $300 billion. So, and Jensen Huang sees massive increases, continued increases in capex. And he does say that humanoid, robots, self-driving, AGI all need GPUs and computes, and we're living in the greatest time in human history. So you're looking at some, really crazy upside from the current capex figure at the moment. But I don't think this figure includes all the hyperscalers. Maybe hyperscalers is half of that, but you're still looking at like very, very substantial growth. Now, where does it leave us with valuation, and what price should we buy Nvidia? Now, looking at the next 12 months, you can see that the EV to EBITDA for Nvidia is about 26.2 times, price to earnings of about 33 times, and a shareholder yield of 1.28. And so plugging in, the trailing 12-month revenues, assuming 18% revenue growth through 2029, which is slightly below consensus. Consensus is looking for about 20.5%. And then using a 60% free cash flow margins, right, through 2029, which I don't think is crazy. You get, about $200 billion in free cash flow in about 5 years from now, up from about the 88 billion. And this is for the full year. The current EV to free cash flow is 53. Now, if we apply a 22 EV to free cash flow in 2029, that's just a market multiple. You get the enterprise value right here, subtract the net debt, and then divide by shares outstanding. You get a stock price in 2029 of $195. The stock currently trades at 134. So you're looking at about 7.6%, compounded annual returns with a 22 times multiple. I think a better multiple would probably be something like 30, especially if like 18% growth with 60% margins holds up. I don't think a 30 multiple is crazy. In that situation, Nvidia can compound at about 17% using a 30 multiple. But we're going to use 22 because I always try to be fairly conservative with these. And so would I say Nvidia is a buy right now? I would say yes. It's trading slightly above its current fair value at 110. It's at 134. It's probably closer to, maybe 140 now after the run we saw in the after hours. But I wouldn't say that is a crazy return, especially if the multiple is to more than half over the next 5 years, which I don't think is the case. I think, we'll probably see an EV to free cash flow multiple closer to 30, maybe even 35 for something like Nvidia. When you are a leader in the space, you're going to trade at a perpetually elevated multiple relative to its peers. And so when you look at the technical charts, assuming Nvidia is a buy on the fundamentals, as well as the discounted cash flow analysis, on a technical basis, is it a buy now? Nvidia has gapped up. Now Nvidia has actually gapped up ever so slightly here in the after hours, right? So we've had a massive gap up. And you can see that if we are to break above this 140 level, which it is at the current moment, Nvidia would be, breaking above some of this key resistance levels we made, and it would be inside this congestion zone right here. If we can sort of have like a gap up and rally, maybe even break above, hit these all-time highs here for Nvidia, I think then, in that situation, Nvidia could probably go to like the 180 level right there, especially considering that, at the end of 2029, you're looking at $195 stock price. I don't think it's absolutely crazy to actually see Nvidia trade at that price or close to that price, over the next 3 or so months. So is Nvidia a buy? I would say yes, Nvidia is a buy. It was an absolute steal here at the $80. And if we ever do get back there or closer to the 110 level, I would say Nvidia is certainly a buy and something to hold in your portfolio, especially if the growth plans that Jensen is alluding to pans out in the way he expects. But guys, if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.